So because we moved off that 1 minute chart, a bellwether time frame for me is 15 minutes. Okay, so if I'm looking for something that is liquidity based, where I'm looking for a draw on liquidity that's going to have an impact for the session. I'm not talking about an hour candle where I can trade inside a 1 hour candle and I can get a scalp and I can make what an average person can earn in a week with every single 1 hour candle. I don't need to do that. You shouldn't try to do that. But for the sake of understanding the highest degree of probability where the market's going to reach for, you have to come off that 1 minute. You got to come off that 5 minute, go to at least a 15-minute time frame. Why? Because the majority of short-term fluctuations that's going on in intraday algorithmic price delivery is on that time frame. Now I'm going to say it in simpler terms. The liquidity you're looking for as a general go-to that's going to serve you the best is a 15-minute time frame chart. That's the ones that are so clear and they're obvious. They don't hide them from you. They can never hide them from you because this is the first one they work off of. Period. I'm going to show you. It's not hard. When we're in this little consolidation here, which is all part of this larger consolidation that's to the left, you see all that? Where is the market jagged versus where it's smooth? Now, for the folks that don't know English very well, what do I mean by that? Well, if you look at the difference between how this high and this high and this high and these highs here, you can pretty much see how these are all like real uniform. It's real smooth. It doesn't make any kind of real jagged run up and run away. Notice that? But where do we see that type of delivery and price? Down here. This is all jagged, okay? So if you were looking at it like a sawtooth or the edge of a saw or some type of serrated edge, down here, they cut up all of the liquidity that was resting below that low, they ripped through it. It caused this one here. And then what did it do? It ran right up here, but then it left this nice smooth little area right in here. So what happens is that retail-minded traders, they see this price action and they envision this little area right in here. This is their safety or safe house. That's this little area right here where they feel that if they go into the marketplace and they try to go short, they feel that this is but the idea is this is a safe space for retail traders because they trust this as what? They see this as this is resistance. They think that price cannot get through that. This is strong resistance. So that means what? The market has to bend to its will if they're classifying that as resistance? That's exactly what those books taught me. And I lost my fucking ass. Okay? I lost my ass trying to use that logic. Every single time I trusted what I thought was obvious and strong resistance, if it looks smooth like this, you can bet your ass they're running through that. Just like the SWAT team's going to kick that door in. They've already done the SWAT move down here. They've already busted through the door. It's all busted up and jagged. Here, it's all smooth. Real smooth highs. And they do this to instigate the idea that it's safe to trust that as resistance. So what will traders do? They'll want to go short. So when they go short, if they're thinking about protecting their money, and that's a good thing, they'll place their stop loss right above these highs. What kind of stops? Buy stops. Okay, so they're thinking that if they can go short in here, or they don't catch the move, they see this run here, what are they going to do? They're going to chase it. They're going to chase it and go short. Then they have all this potential inefficiency they could actually see go against them while they're in a trade, and that might squeeze them out. Or if they're just a chaser in price because they don't know where the market's going to go and they haven't really over leveraged, they use the smallest in terms of leverage, they can afford to even chase it, even though that's not a good way of trading, but they can afford to put a stop loss up here because they're not trying to trade with 15 contracts. Wink, wink, nudge, nudge. They have the smallest leverage on, so they're going to place their stop loss up here. because they understand they're not that great in terms of precision, but they know that this is proven to them that they think it's going to be acting as resistance. It's not, but that's what they're being trained to think. So if you do this over and over and over again, reading books, looking at the examples that they want you to see, you will believe, you will be indoctrinated, seeing that this is resistance. So therefore, the market should not go through that. See how that it ingrains in your mind that you're going to believe it because you paid for the book. You took the time to read the book. And these people are claiming they've been doing it before you and they claim it works. So right away, you're being brainwashed. There's no need to go down below all this stuff or even revisit it when this is left intact. This is all smooth. This is all smooth. And it needs to be made jagged. So if price is down here, how do we use that logic? To answer my son, I said, look where this is smooth. And you see how this is smashed down several times? It looks like, sharp teeth on the side of an edge of a saw, right? So they tore us all up down here. And this is all left smooth and intact. So when we're in these small little consolidations like this, and you don't know what side the marketplace is going to run for, look for where it's left smooth edges. That's this side here. I was not bearish this morning. You should not have been bearish if you were a student of mine, because we've already seen how they've done the damage down here. Plus, the market is still trying to reach for that old daily high. So while we're in here, we're going up into what? Time. The importance of time cannot be diminished. All of the real moves, the sustained price runs that run for significant price runs to inefficiencies or liquidity, are going to be based on a time delivery schedule. It is always based on time. Time. Without time, you can't do shit. Period. You can't do anything. Because if the market ain't open, can you put anything into a trade? No. That you might argue and say, well, that's the extreme argument. And of course, it goes without saying. But none of the sustained price runs or significant price runs ever manifest themselves out of the time periods that I pointed out. Look at the macro. That's a small window of time. 20 minutes, 20 little minutes, okay? And I can time every significant price run that's going to occur intraday on a 1 minute chart. That's what a macro does. So don't discount time or place price over top of time. Time is always going to be paramount and above price. Always. Every instance of it. Every single instance. Time is going to be the absolute paramount principle that is going to be the largest factor in why price is going to move. Don't believe me? Look at the economic calendar to cancel any argument against it initially right away. Because CPI tomorrow, when that comes out, it doesn't matter what the fuck you trade. It's going to rip your face off. It's going to rip your face off. You're not going to be able to trade it. You're going to be decimated. And nobody can stand in front of that. Not with any assurity that they're going to be, having an outcome that's favorable. Not consistently. And I feel like I'm a pretty good trader, and I can't find consistency ahead of CPI every single time it comes around. Once in a while, I'll get it right. Once in a while, but most of the time I'm not. So I have to wait for that first initial delivery and then look for where it left porous wake in that price run. That means inefficiencies, fair value gaps, and what liquidity in terms of old highs or old lows that they left smooth like this. Because you can clearly see at this level here, 16,120 has buy side or buy stops resting above it because it's smooth. You don't need a depth of market. You don't need level 2 data. You don't need a market map or book map or anything else out there to do this. It's all on one chart, one time frame. It's the 15-minute time frame. Okay. The same thing we see. What is this over here? Aren't they smooth? These are smooth. These are smooth. It's all part of that same consolidation, isn't it? What do we have right there? It stepped outside of it. Did it stay there? No. Did it retreat away from it? Yes. But we're going into the time. What time? 8:30. But there's no news coming out at 8:30, Michael. It doesn't fucking matter. Because 8:30 is when the algorithm's going to do it. It doesn't matter if there's no news there. It doesn't matter if your economic calendar says there's a medium impact news driver or a low impact news driver or a high impact news driver. It's going to start running based on that time of day. Now, That means, okay, listen, friends and neighbors, listen. If we can look at price like this, we can already come to the conclusion that we want to anticipate and expect and not be fucking surprised when the market goes up at 9:30 and into the lunch hour. Why? Because it has all of this and this on the daily chart to reach for.